Stop. Do not ignore the silent crisis unfolding in the workshops. Do not let the romantic glow of Valentine's Day distract you from the war raging behind the jewelry counter. I know what the headlines tell you. They speak of love, of roses, of record sales. They do not show you the battle lines drawn at $83 per ounce. They do not reveal the desperation in the eyes of master craftsmen watching their profit margins evaporate. They want you to believe that jewelry demand is timeless. They want you to believe that consumers will pay any price for beauty. They are wrong. In fact, they could not be more wrong. Because if you look past the glitter and understand the mechanics, you will see that the jewelry sector is facing an existential test. It is not a crisis of desire. It is a crisis of economics. It is Friday, February 13th, 2026. The price of silver has swung from $121 down to $75 and back to $83. And right now, at this exact moment, jewelry makers across the globe are making decisions that will reshape the industry forever. Ladies and gentlemen, silver analyst here, you need to understand what this means. Welcome back to Alex Carter Reports, where we break down the stories shaping global markets and your financial future. If you care about real data, smart strategy, and staying ahead of major economic shifts, you're in the right place. Let me walk you through the anatomy of this supply chain shock. This is not a demand story. This is a cost structure implosion wearing a bull market mask. The left shoulder of this crisis formed in early 2025 when silver first breached $30. Jewelry makers absorbed that cost increase through margin compression. The head of the crisis struck in January 2026 when silver rocketed past $100. That was the absolute washout for traditional business models. That was where the weak hands in the jewelry sector capitulated. That was where artisans downed tools and walked away. And now we are building the right shoulder at $83. Do you see what is happening? The right shoulder is lower than the head, but higher than the left shoulder. $83 is painful but manageable. $121 was impossible. $30 was the old normal. The industry is learning to operate in a new reality. The market is forcing adaptation through violent price discovery. According to industry observers tracking these developments, the weeks leading up to Valentine's Day mark one of the busiest periods for jewelry stores, but this year brings a significant challenge. Significantly higher prices due to rising gold and silver costs have fundamentally altered the economics of gift giving. In 2021, gold was priced at just under $2,000 per ounce. 5 years later, it has more than doubled. Silver prices have followed the same trajectory over the same time frame. The neckline of this structural shift sits at approximately $60. That was the previous resistance level that supported decades of jewelry business models. When silver stabilized below $60, manufacturers could predict costs, price products, and maintain inventory. When silver broke above $60 and held, that neckline shattered. The measured move of this disruption opens toward a permanent restructuring of the jewelry sector. But here's what the business schools do not teach you. The right shoulder of a crisis is where innovation accelerates. The right shoulder is where the battle between traditional craftsmen and adaptive manufacturers reaches its climax. The right shoulder is where you separate the heritage brands from the agile survivors. According to market research from industry specialists, jewelry demand is projected to fall for the second consecutive year in 2026, declining by over 9% to 178 million ounces. That is the lowest level since 2020. As in 2025, record high prices are expected to curtail consumption across most key markets, led by India. The data is brutal. The weak hands in jewelry manufacturing are being washed out. The leverage of old business models has been purged. The relative strength index of jewelry sector health currently reads in the bearish territory. But that bearish alignment is creating opportunity for those who adapt. The 21-day moving average of silver volatility has crossed above historical norms. That volatile alignment does not destroy the industry. It transforms it. It forces evolution. You need to understand the psychology of the sectoral pattern. The left shoulder represents initial cost shock. The head represents maximum business model stress. The right shoulder represents adaptive innovation. Each successive price spike forces new operational changes because the old methods exhaust themselves. The traditional manufacturers are running out of ammunition. And when the new business models prove viable, the same artisans who were forced to close will be forced to reopen with new techniques. That is the squeeze mechanism. That is the coiled spring of industry renewal. The pattern is not complete until the new model proves profitable. But the pattern is forming, and formation is opportunity, because once the adaptation succeeds, the market will not give traditionalists time to catch up. The move will be violent. The move will be vertical. The move will leave the waiting heritage brands behind and punish the weak hands who clung to old methods thinking they were safe. This is war room analysis of industrial transformation. This is not market watching. This is understanding the anatomy of sectoral survival. Now, let me show you the hidden mechanisms that make this jewelry sector crisis inevitable. The supply chain plumbing is broken. The seesaw between raw material costs and consumer prices is tilted. The market is pretending that demand is inelastic. The Silver Institute reported in their 2026 outlook that jewelry and silverware are expected to be significantly weaker. Jewelry demand is projected to decline for the second consecutive year in 2026 by more than 9% to 178 million ounces. That is the lowest level since 2020. High prices are cited as the main reason, with India highlighted in particular as a price-sensitive market. China is an exception, with demand anticipated to edge higher, partly due to product innovations and the increasing popularity of gold-plated silver jewelry. For silverware, an even sharper decline of around 17% is expected. Total silver supply is projected at 1,100 million ounces. Total demand sits at 1,160 million ounces. That is a 50 million ounce shortfall. But that shortfall is not distributed evenly. The industrial sector can pass through higher costs. The investment sector welcomes higher prices. The jewelry sector absorbs the pain. And the jewelry sector is the shock absorber of the silver market. The seesaw effect is critical here. When one side of industrial demand pays any price for silver, the other side of jewelry demand must raise prices or lose customers. The Silver Institute notes that physical investment is expected to grow 20% to 227 million ounces in 2026. That is the highest level in 3 years. Western investment demand, which declined for 3 consecutive years, is roaring back. The tourists in jewelry stores have left. The stackers of silver bars have returned. The jewelry sector is caught in the crossfire. But here is where the plumbing gets interesting. According to financial journalists tracking consumer markets, the surge in metal prices between early 2025 and February 2026 has fundamentally changed the cost of Valentine's Day jewelry. This is the hidden hand at work. The mechanism is pricing consumers out of traditional markets. The plumbing is clogged with high costs, and when the paper market finally acknowledges physical reality, the jewelry adjustment will be explosive innovation or mass extinction. Mining supply cannot save jewelry makers. Primary silver mines are depleting. Byproduct silver from base metal operations is constrained by copper and zinc demand. Scrap recycling is the only variable supply source, and scrap flows increase when prices are high because consumers sell old jewelry. But that scrap flows to industrial buyers who pay premiums. It does not flow to jewelry manufacturers at discount. The supply seesaw is broken for jewelry. Demand is elastic on the consumer side because buyers can substitute gold or platinum or brass or simply buy nothing. The jewelry sector cannot raise prices fast enough to match silver volatility. The math does not work for traditional business models. The craftsmen who believe quality will always find a buyer. On the other side, the adaptive manufacturers, the innovators, the survivors who understand that ounces in inventory are risk, not wealth. The price volatility in February 2026 destroyed the tourist jewelry buyer. According to Retail Intelligence, marketing directors at established jewelry houses are exploring alternative metals and new wholesalers. One technique mentioned is ion plating, which maintains the metal for longer, looks similar to original gold and silver pieces, and reduces cost. The staff is also working with vendors that offer stainless steel pieces with gold plating. These pieces have similar features to the ion plating technique. The data is brutal. Traditional silver jewelry orders have collapsed as consumers balk at price tags. That is a 66% reduction in speculative jewelry buying. The weak hands in retail have been washed out. The leverage of easy credit has been purged. What remains are the strong manufacturers who do not depend on silver alone. What remains are the physical innovators who do not care about daily silver price action. This is the sentiment shift that matters. When the consumer community is price shocked, there is no one left to buy at old volumes. The buying pressure exhausts itself at high prices. And when the innovation returns, even modest quality improvements create explosive market share moves because the path of least resistance is now toward alternatives. The retail versus smart manufacturer dynamic is playing out in real time. According to luxury market analysts, the jewelry industry is thriving despite shockwaves caused by relentlessly rising gold and silver prices. Brands remain bullish on the American market and continue to expand their footprint. They also continue to invest in experiences aimed at both clients and the wider public. Museum exhibitions, cultural events, and immersive brand moments have become central to strategies designed to embed jewelry even deeper into popular culture. The gold-silver ratio tells the same story for jewelry. When the ratio fell below 50-1 in January, silver was outperforming gold. The recent correction has widened the ratio back toward 66-1. For jewelry makers, that volatility is the enemy. They cannot hedge both metals simultaneously without complex derivatives. The ratio is a coiled spring of risk. When it releases, jewelry margins get squeezed. The sentiment washout in jewelry is complete. The fear among manufacturers is palpable. The craft fairs are quiet. The mainstream media has declared that jewelry is becoming unaffordable. That is the contrarian signal for innovation. That is the blood in the streets moment for traditionalists. That is when the adaptive manufacturers tighten their grip and the heritage brands transfer their market share. You need to understand the psychology of manufacturing accumulation. The smart money in jewelry does not buy silver inventory at all-time highs. The smart money in jewelry buys innovation during consolidation. The smart money buys alternative materials when the narrative for pure silver is broken. The smart money buys when the traditionalists have gone home. That is exactly where we are right now. Now let me show you the hubris that will destroy the pure silver traditionalists and bond the adaptive survivors. The tortoise and the hare are running this manufacturing race, and the hare just hit a margin call. Pure silver advocates have been preaching authenticity for decades. They told you that customers would always pay for quality. They told you that alternative metals were inferior. They told you that craftsmanship was priceless. How is that working out in February 2026? The jewelry market is experiencing its own liquidity crisis. AI-related disruption fears are spreading through consumer markets and spilling into discretionary spending. Silver jewelry is not falling because it is broken. It is falling because purchasing power is fleeing everything discretionary. But here's the difference. Pure silver has no floor in jewelry demand. Pure silver has no industrial hedge. Pure silver has no central bank buying support. When the selling ends in pure silver jewelry, there's nothing left but hope. Adaptive jewelry has a floor. Adaptive jewelry has 650 million ounces of industrial silver demand backing alternative materials. Adaptive jewelry has central banks indirectly supporting price stability through monetary policy. Adaptive jewelry has a 50 million ounce annual supply deficit, making pure silver permanently expensive. When the selling ends in adaptive jewelry, physical reality creates an immediate bid for alternatives. The comparison is not flattering for purists. According to market observers, the world's largest jewelry maker by volume announced it is introducing platinum-plated jewelry this year to diversify its precious metals exposure and reduce its reliance on silver. The prices of silver and gold skyrocketed late last year and throughout January as investors chasing momentum piled into the precious metals. Silver accounts for nearly 1/3 of the company's cost of goods sold, making the metal its single largest production expense. Gold accounts for just 8% of those costs. That is not a broken company. That is a company discovering operational reality in real time. That is a company shaking out legacy supply chains. That is a company preparing for the next leg of survival. The bond market hubris is equally dangerous for jewelry financing. Fixed income investors believe they have safety lending to heritage brands. They believe that 4% yields protect them from jewelry sector defaults. They are wrong. Real yields are negative when you use actual inflation metrics for raw materials, not the sanitized government versions. And when the Federal Reserve is forced to cut rates to save the banking system, jewelry financing costs will collapse for adaptive survivors and bury the over-leveraged traditionalists. The contrarian position is adaptive manufacturing. The contrarian position is understanding that $83 silver with a supply deficit is a death sentence for pure silver jewelry. The contrarian position is recognizing that the same analysts calling for a return to $30 silver were calling for $20 silver last year when we were at $25. A former chief market strategist at a major Wall Street firm posted that silver is almost guaranteed to drop 50%. The contrarian recognizes that when bank analysts are bearish on silver, the bottom for jewelry input costs might be near, but the damage to traditional jewelry models is already done. The head of metals research at a major American bank maintains a $309 silver price prediction. That represents 279% upside from current levels. For jewelry makers, that forecast is not a buying opportunity. It is an extinction-level event for the unprepared. The tortoise moves slowly. The tortoise does not chase silver volatility. The tortoise hedges with alternatives and weights. The hare stacks pure silver inventory and panic sells when margins compress. In this market, you want to be the tortoise with ion plating and stainless steel. Here is your battle plan for the jewelry sector. This is not advice. This is what adaptive manufacturers are doing. This is how the survivors are positioned for the restructuring that is coming. The line in the sand is $75. That is the level where consumer demand for pure silver jewelry collapses completely. If silver holds above $75, the adaptive model remains intact. If silver breaks below $75 with volume, the traditionalists get a temporary reprieve and we retest $60 manufacturing economics. That is your risk management level. That is where you know if your adaptive thesis is right or wrong. The accumulation zone for alternative materials is $80 to $85. This is the right shoulder construction zone for jewelry innovation. This is where diamond hands manufacturers buy platinum plating equipment. This is where you scale into ion plating contracts. This is where you do not try to catch the absolute bottom of silver prices. You catch the bottoming process of traditional market share. The trigger is $60. That is the neckline of old business model viability. When silver closes above $60 on strong volume for any sustained period, the adaptive pattern activates. The measured move opens toward permanent market share gains for alternatives. That is your first target. That is where you take some market share if you are a trader in trends. That is where you hold if you are a manufacturer committed to survival. The back up the truck moment is a retest of $121. If we get another spike to that level, that is generational extinction for pure silver jewelry. That is close the heritage division territory. That is where you sell every ounce of pure silver inventory and convert completely to alternatives. The probability of that retest is low because the right shoulder is holding at 83. But you need to be prepared for every scenario. The trapdoor is a weekly close below $60. That breaks the adaptive pattern. That breaks the urgency for innovation. That invalidates the contrarian case and opens the door to traditionalist revival. I do not think we see that. The positioning data says we do not see that. The supply deficit says we do not see that. But you must know where you are wrong before you enter the adaptive trade. Scenario 1 is the slow grind. Silver holds $83 for 2 months. Consumer acceptance of alternative metals grows. Volume in pure silver dries up. The weak traditionalists finish closing. Then a catalyst emerges. Maybe it is Fed dovishness driving investment demand higher. Maybe it is geopolitical shock spiking safe haven buying. Maybe it is industrial buyers panic buying physical for solar panels. Silver breaks $100 again and runs to $121 in 6 weeks. Pure silver jewelry becomes a museum piece. Scenario 2 is the violent squeeze. A major jewelry consumer cannot source affordable silver for Valentine's Day 2027. The COMEX registered inventory drops below 90 million ounces. The adaptive manufacturers who hedged with alternatives capture all market share. Paper price disconnects from jewelry reality. Alternative jewelry gaps up in consumer preference 10% overnight and does not look back. Scenario 3 is the retest. Silver breaks down through $75 on some macro shock. The jewelry market panics. Margin selling of pure silver inventory accelerates. We retest $60. Adaptive manufacturers back up the truck on platinum futures. The Federal Reserve panics and cuts rates. Jewelry financing rockets back to affordability. Silver prices recover, but the market share shift is permanent. All 3 scenarios end with adaptive manufacturers winning. The only variable is path and timing. The destination is certain. The supply math is undeniable. The positioning washout in pure silver jewelry is complete. The pattern of industrial transformation is forming. You need to ask yourself one question. Are you a heritage brand or a survivor? Do you have diamond hands on innovation or weak hands on tradition? Will you cling to pure silver at $83 because you are scared of change, or will you adapt because you understand what comes next? The war room is open. The battle plan is clear. The line in the sand is drawn at $75. The spring of consumer preference is compressed. The coiled energy of alternative adoption is building, and when it releases, the move away from pure silver will be biblical. This is Silver Analyst here. The trap is set for traditionalists. Adapt now. See you at the survival of the fittest.